Hello, I'm Terry Badger, Managing Editor at BAI and host of the BAI Banking Strategies podcast. Thanks for joining us for our webinar presented by R&T Deposit Solutions, Balance Sheet Management, Maximizing Liquidity with Reciprocal Deposits. Today you'll learn how reciprocal deposits are growing as a way to create liquidity at the ready. Before we get started, a reminder that many of us are still working from home, so there can be technology challenges. If you have an issue on your end, please know that a recording of today's webinar will be sent out to view on demand. And if there's trouble on our end, we'll try to get it fixed as quickly as possible. I also have a couple of housekeeping items. We'll wrap up today's webinar with a question and answer period. At any time during the presentation, please type your question into the Q&A box on your screen, and it will make its way to our queue. Also, at the end of today's webinar, you'll see an online evaluation on your screen. Your feedback is important to us at BAI as we work to address the key issues impacting the industry, especially in today's unique business environment. So please take a few minutes to complete the survey. So with that done, it's now my pleasure to introduce today's presenter. Tom Nelson is the Chief Investment Officer at Rich & Tang. He's responsible for overseeing the firm's FDIC insured programs, sales growth strategy, and product development initiatives. Tom's long history of expertise in the industry includes senior positions at Institutional Deposits Corporation, SunGard, and JP Chase. Tom, let me hand things over to you.
Thank you very much, Terry, and thank you everybody that has joined us today. I just wanted to reiterate, please, if you have questions, feel free to ask them, and I'll try to get to them as we're going through the presentation, but certainly we'll get to them at the end if not. Again, thank you for joining us. So just some quick information about R&T and who we are and what we do. We're a market leader in FDIC insured sweep programs. Everything we do is taking money from various types of investors and placing those monies into FDIC insured bank deposits, whether those funds are coming from banks, credit unions, trust departments, investment managers, broker-dealers, or anybody else. Every dollar that we handle ends up in an FDIC insured account at a bank. So that, you know, bank deposits, extended FDIC insurance is all we do. We're an independent firm. We're not part of a major bank. We're not part of a broker-dealer. We are self-owned and don't really answer from that perspective to anybody but our customers. We have maintained a firm-wide experience in the cash market since 1974. If you asked us in 1974, we would have told you that we were about to open up one of the first money market mutual funds in the industry. We were providing sweep programs to broker-dealers and others, and have evolved into the firm that we are today. That knowledge and history within the cash markets has given us, I think, a tremendous ability to understand the needs of banks and their short-term deposit needs, as their deposits are not acting in a vacuum with the rest of the market. Our experience is wide beyond banks, but focused currently on banks. The key thing that we're going to talk about today, and one of the key products that we offer, is our ability to offer strategic on and off balance sheet and liquidity management programs for banks, and how reciprocal deposits specifically would fit into that. But it's important that we understand that we know that the needs of banks change from quarter to quarter or year to year, or certainly, pandemic to pandemic, shall we say. And we offer a variety of programs that help banks deal with their changing business needs based upon their balance sheet requirements. And we try very hard to be a thought leader and an educator on a variety of regulatory as well as just market situations, whether it's reciprocal deposits as we're talking about today, money fund reform, Basel, broker deposit rule, which I will touch on a little bit today, the broker deposit rule and the impact that it has in some of these spaces. But we try very hard to be an educator as well as a influencer when it comes to the regulatory changes. So as we indicated, we're going to focus on reciprocal deposit program, walk through what they are and how they work and how they can help a bank with their balance sheet needs. DDM is our demand deposit marketplace. As the name indicates, every deposit, every part of that product is in a demand deposit, whether it's a MMDA or DDA, every dollar is liquid. It's a completely on-demand program. The interest and focus around this product today is more centered around reciprocal deposits than it ever has been. I can talk about why, but largely that was because of the CREPO legislation that was passed in May of 2018. Banks can use our reciprocal deposits program to free up collateral and help them focus on gathering, especially municipal deposits and other kinds of deposits that require either collateralization or FDIC insurance, and whether that requirement is a legal requirement, as it is in the case of most municipalities, or a desire/demand, as it is in the case of many small businesses, small companies, investors in general. We understand that collateral acquisition is a very expensive way for many banks to acquire deposits. Acquiring collateral in order to get municipal deposits is very difficult. Collateral tends to be less available today than it has been at any time in the past. So banks aren't sitting on tons of free collateral that it can use to collateralize municipal deposits. And DDM is often a much more cost-effective way for a bank to acquire these deposits without having to give up what little collateral many banks have at their ready, leaving that collateral available to use for home loan advances or other funding sources instead of using them up to garner individual municipal accounts. One of the big things is that with DDM, you have the ability as a bank to throttle up and down the amount of deposits that you take on your balance sheet at any time. So with a reciprocal program, the standard base case it might be that you send us $100 million worth of deposits, we send you $100 million back. Doesn't mean that that's the way it has to be. You'd have the ability to send 100, take 50 back, send 100, take 150 back, depending upon your needs at any time. Every dollar of customer money that comes into the program, as I indicated before, is going to be placed in a demand deposit. Therefore, it's going to be 100% liquid at all times and can be returned at any time. There are no lockup periods, no CDs in the program, no term deposits. You can put the money in today, leave it there for 10 years, or leave it there for 10 days, or leave it there as long or as short a time frame as you want. And as I indicated, one of the big things is that you're giving the bank the ability to raise the amount of deposits it takes through these programs is a key component. Another thing to make note of is that as banks use these programs, as they use this program, there is no limit on the rate that you can pay customers. So you set the rate wherever you want to set the rate. If you're fortunate to be able to raise money at 0 or at 1 basis point from clients, that's where you set the rate. That's where the basis is going to be for your cost of funding. If you're in a higher rate market where you have to pay significantly higher, 20, 30, 50, 70 basis points for client balances, you can set the rate as high as you need to to garner customer deposits into your bank. We don't control what you can and can't do, or from a rate perspective. So how does the demand deposit marketplace work? It's pretty simple from the perspective that it all starts with a client deposit, whether that's a small business, an individual, a municipality, whatever it might be, who has a relationship with a sending bank. That's the terminology we use for the bank that, is the relationship bank for that initial tax ID / social security number depositor at the bank. That bank, on behalf of that individual tax ID or social security number, sends money into the DDM program, is paid a rate back from the program based upon the interest that the bank is, the banks are paying us for the deposits that we give to them. So in this case, client walks into brick and mortar bank A, that's the sending bank sends it to Rich and Tang. We then in turn send it out to as many banks as necessary in increments of $250,000 so that deposit is fully insured at all times. I'm sorry, lost train there for a second. Now, your individual customers has full access to their cash on a daily basis, and the key thing is that we're working behind you. You're the only one that's going to have a relationship with your client. They're not going to call 1-800-RNT when they have a question. They're not going to send an email to the help desk at RNT when they have a question. They're going to continue to interact with whoever they might have interacted with at the bank before. We stand behind you. We'll support you in any way as necessary to talk to your clients, and if you want us to talk to your clients, we're happy to do that with you. But we don't want to be the point of contact. We don't want to be put in a position where the bank, or put the bank in a position where it begins to lose any piece of the relationship it has with that client that it's worked so hard to bring into the firm. So how does a bank, one of the key things about DDM, we're going to focus on reciprocal deposits in a minute, but there are three different ways that a bank can use our program. It can send deposits in, it can take deposits back, or it can do a reciprocal program, which in essence is doing both. So in times, especially times like these, when banks are looking to send deposits off their balance sheet, how does it do it? Well, we take deposits, as we indicated before, and send those deposits out to a variety of receiving banks on behalf of each tax ID to ensure that tax ID is fully insured. Now, if the bank doesn't want those deposits back, the bank in essence wants to shrink its balance sheet or keep its balance sheet low, but not lose their relationship with customers. They simply send those customers into us. They maintain that relationship with the customer. They continue to offer their customer an FDIC-insured solution or a bank deposit solution, whatever terminology you might want to use with your end client. We send the money out to banks that want the money at a given time, and those banks then in turn pay interest back to the sending bank on behalf of their clients. And again, each of those banks for each of those clients has the ability to set the rate wherever it wants. If the receiving bank is willing to pay us 50 basis points and you only pay your client 10 basis points, you get to keep 40 basis points. And on the other hand, if you want to maintain that relationship and have to pay a higher rate and are willing to subsidize the rate in order to maintain a relationship, you want to pay your client 60 basis points and the banks are only paying 50 basis points, you would supplement that income with 10 basis points. Banks often do that kind of a transaction because their overall interest in keeping that original customer is so high because of the other businesses that it does. That is a price that many believe is worth paying to keep that customer within the family of the bank. But more often than not, this is used by banks to turn the customers that they've built up into fee income by paying less to their customers than what they're receiving from the DDM program from the receiving banks, and keeping the difference in some sort of a spread slash fee income opportunity. The key thing there is that once those clients are in the program and have signed up to use the program, they don't know that the money is never going to be reciprocated. All they know is that their individual funds are being placed in other FDIC institutions, and they're fully FDIC insured, at all times. They don't know whether or not you're taking money back at a given time. So it gives the bank the opportunity, when it's flush with cash, to bring new customers in, send them out in this kind of a structure, have no impact on their balance sheet. But when their balance sheet turns around and they need deposits because loan demand is picked up or whatever it might be, they simply have to call us and say, we're sending you $100 million, we're taking nothing back, we would like to start taking $25 million back tomorrow, 50 million back, 75 million back, 100 million back, whatever the right number is at a given time. So it creates kind of an inventory of deposits that banks can call on as their balance sheet requires it or is able to take it. Now, the other way that a bank can use the program is to add deposits to their balance sheet. So if one thinks about what I just described, if you're on the other side of the transaction and all of the customers that you have currently, you're able to keep on your balance sheet, they're happy with the level of insurance that they're getting from you, okay with balances that are over 250 being uninsured, whatever it might be, but you just need some excess funds, then you'll be on one of the banks on the other side, where there's a bank or other entity that's sending money into the program that isn't going to be taking that money back, and you can stand there ready to take deposits back onto your balance sheet, to grow your balance sheet to meet loan demand and things of that nature. Many banks find this is a very attractive source of funds because it is, again, something they can throttle up and throttle down over time, and doesn't require them to open up a new branch, doesn't require them to post a CD special that will hurt the overall funding costs of all their existing customers, and just gives them a level of flexibility that they otherwise wouldn't have. So how do reciprocal deposits work? Well, in the base case, when what we refer to as 100% reciprocal, a bank will send in deposits on behalf of its individual customers. We will allocate those balances to third-party banks on a tax ID level. So municipality A sends in 10 million, we send it out to 40 banks in increments of 250. Small business B sends in 6 million, we send it out to 24 banks in increments of 250,000. So each of those end clients is fully FDIC insured. We then turn around and say to the bank that's sending the funds in, we are going to return to you deposits from other customers, other individual tax ID customers in our program. And anytime I say tax ID, obviously I'm referring to tax IDs or Social Security numbers. We will return an equal amount of deposits back to you from other customers in our program. So that you send in $47 million, you take out $47 million. You send in $462 million, you take out $462 million. But all the funds that you take back are going to be in increments of $250,000 and fully FDIC insured at all times. And unlike what you would have to do through a traditional, branch network banking structure, you don't have to open up accounts. You'll never open up accounts for all of the underlying customers. You'll never have any accounts other than DDM for the benefit of its customers. So there'll be one checking account, one MMDA. You have the option of which ones you might want to use. And whether you have $1 million, $10 million, $100 million, or $1 billion, all of the money will flow back into that one account at your bank that's DDM for the benefit of its customers. So it becomes a very simple operational structure that allows you to get large amounts of deposits without having to open up dozens, hundreds, thousands of accounts. Now, in the case of 50% reciprocity, just to throw out an example of a number, you would send in $100 million or in this case, what we say here is you send in $1 million worth of customers funds. So customer A has $1 million, you send it in, we send it out to 4 banks, but then we only send you back $500,000 because you only want $500,000. You want $500,000 off of your balance sheet. That is how we would accomplish that. The $1 million that goes out to those 4 banks and 250 stays there, and then we only send you back 2 customers of $250,000 instead of 4 customers of $250,000. And there, in that process, you've effectively reduced your balance sheet by $500,000. We have banks that have reduced, that are in some cases hundreds of millions of dollars underfunded. In other words, they're sending in hundreds of millions and taking back, significantly less than that. And we have situations where banks are overfunded by hundreds of millions of dollars. So this could also have an example of 150% reciprocity, where you send in $1 million and take $1.5 million back. Tremendous flexibility there to increase or decrease your reciprocity. And really the impact there is increase or decrease the amount of deposits that you have on your balance sheet so that your balance sheet can stay much more in line, or in equilibrium, I should say, with what your needs are on a given time. Now, there are a tremendous amount of regulatory considerations that go into these programs, and I think in 2018 we saw what was undeniably the most important regulatory change that affected these programs. Before the Crapo bill was passed, the financial reform bill in May of 2018, we tend to call it the Crapo bill, based upon the sponsor. This is a bill, first, that had wide bipartisan support, focused on a wide variety of consumer protections and regulatory relief for banks. It would take me about a month to describe all the things that were involved in the bill, and we're just going to focus on one small piece there and its impact on reciprocal deposits. But before, the key thing about this bill is that before this bill was passed, any deposit a bank took back on its balance sheet in the form of a reciprocal deposit had to be considered brokered. And this rule specifically laid out that to the extent that a bank puts a deposit of its customers into this program and then takes a reciprocal deposit back, those deposits would remain core. To the extent that the original deposit was core, which would be the vast majority for all banks, the deposits they take back would be core as well. Now, there were limits put on the amount of deposits that a bank could classify as core. There is no limit on the amount of deposits that a bank can do from a reciprocal perspective. There's only a limit on the amount that it considered to be non-brokered / core. That limit is 20% of its assets or $5 billion, whichever is less. Obviously for any bank over $25 billion, the $5 billion would be the limit. For any bank under $25 billion, 20% of its assets would be the limit. So for a $10 billion bank, They can do $2 billion in reciprocal deposits and consider those deposits to be core. They can in fact do, and we have a number of banks that do more than 20% of their balance sheet in reciprocal deposits. They would simply have to classify that piece over 20% as brokered instead of being core. This rule and the changes that it created by making these deposits core provided banks the flexibility to move from their current collateralized deposit structure and into a program like this and free up valuable collateral. Collateral is far less widespread, as I indicated in the beginning, I think as everybody probably would agree on the call, than it was 15, 20, 25 years ago at banks. There's far less securities held on banks' balance sheets than there were many years ago. So banks aren't just sitting on all kinds of collateral that it can use to collateralize deposits. This program then allows banks to go after customers without having to try to buy collateral, which in many cases defeats the purpose of getting the original deposit. In doing so, this allows reciprocal deposits to be a tool for non-SIFI banks, non-bulge bracket banks, to compete on a level playing field for larger corporate, individual, small business deposits that might otherwise go to a bank that's too big to fail. There are a lot of customers out there, again, whether it's by statute in the case of most municipalities or just by desire in the case of many corporates and individuals, who don't want massive amounts of uninsured money at any individual bank, and will, in many cases, go up market in bank size to where they feel they get closer to, if not all the way to, a too big to fail, bulletproof type balance sheet. This program gives these banks a way to compete head on with the JP Morgans, the US banks, whatever bank it might be, because the deposit that the client's going to have is going to be fully FDIC insured at all times. And another critical component was that once these deposits became core as opposed to brokered, banks can continue to take the reciprocal deposits back onto their balance sheet even if they fall to adequately capitalized. So before, when deposits were considered brokered, if we had a bank in our program and they were using us from a reciprocal deposit perspective and they fell from well to adequately capitalized, existing guidance would have indicated that we had to basically close that account effectively immediately. And that bank would lose access to all of those deposits that it had been taking back on its balance sheet. Now, banks are allowed to continue to take those deposits even if they're adequately balanced, even if they're adequately capitalized. There's some limitations there, but broadly speaking, being adequately capitalized does not affect your ability to take these deposits. Now, another rule that came in on it's on broker deposits was just the one that was recently issued in December of 2020 that clarified some of the things that we just talked about. For instance, there were issues around what was and what was not an at-maturity deposit. Whether or not an MMDA had to be closed immediately, what was the definition of a deposit broker. And what this rule did was, one, revise the regulations around interest rate restrictions and caps that apply to banks. It also listed a series of heretofore brokered deposit takers that are no longer considered brokered deposit takers. So it's broadened, on a separate topic. We would welcome the opportunity to talk to any of you about ways that we can help you find core deposits now from many of our customers that up until this rule passed would have been considered brokered deposits. And the new framework just really establishes the specific aspects of what is defined as a deposit broker. Now, one of the things that I just talked about was the whole issue of adequately capitalized. Now, in the case of brokered deposits, so to the extent that somebody's using our program from a brokered perspective, using our program from a receive-only perspective, there are issues about being well capitalized versus adequately capitalized. And I think the key issue that for people that use this as a receive-only program or partially received program, again, heretofore they would have had to lose those deposits the second they became adequately capitalized. Going forward, basically, they can't increase the amount of deposits that they take from a program such as this. And they can't start taking deposits from new underlying customers, but they can keep all of the deposits that they've had on their balance sheet. So becoming adequately capitalized is not, quote unquote, a death knell the way it might have been for this type of deposit 6 or 12 months ago. I'm just going to skip over this one for now. Now, within the demand deposit marketplace, the kinds of accounts that can be used, the kinds of accounts that you can bring into the program are only limited to the kinds of accounts that you're legally allowed to open up an account for. If you have any type of an account that you have the ability to open an account for, you can put that deposit into our program. These are just a few examples of the types of accounts. But the key thing through this whole program is that the originating bank, the sending bank, is required for doing all know your customer and the rest of the alphabet soup of requirements that a bank has for its customers. So each bank that is taking deposits into this program from some other bank's customers is relying on that other bank to have done the appropriate due diligence, all of, again, the know your customer, anti-money laundering, etc. types of things, so that the funds that you're taking back from individual customers, whether that's a municipality, a small business, an individual, whatever it might be, you as the receiving bank never have to do due diligence on those clients. You simply rely on the bank that originated the funds to have done the due diligence. We go through an annual process where every bank attests to the fact that they are in fact following that and doing that on an annual basis as is required by the FDIC for these types of accounts. Now, it's important that as you're marketing a program such as this to your client, you think about what the benefits of a program are, of a program like this would be. Now, this becomes critically important when a bank starts to look outside of its traditional, what I often refer to as brick and mortar customers. In other words, traditional banking customers of all types. Many banks have wealth management departments, whether you want to call them private banks, whether you want to call them wealth management, but there are thousands of banks in the country that have some type of wealth management private banking structure in their system. More often than not, those deposits exit the bank going to mutual funds or something else. Not always, but certainly in a lot of cases, those deposits leave the bank altogether. And the bank is faced with the odd situation of having fought for a client, but then that client's cash in their investment account ends up going to Federated or Goldman or Fidelity or somewhere other than the originating bank. these programs provide the ability for banks to more easily access those deposits from their wealth management businesses. And again, as I indicated before, access those deposits on a reciprocal basis, access those deposits on a way that can allow the bank to throttle up whether they want to take those balances or not at any given time. There's often a concern by banks about taking money from the wealth management because the numbers can often be very large, not always fully predictable, and they don't want to be in a situation, certainly on the trust side, they don't want to be in a situation where day one money is going back to the bank, day two money is going to a third-party bank, and day three money is going to a money fund. With a program such as this, those deposits can come exclusively into DDM, and then the bank, again, through its decision about reciprocity, can decide whether or not it's going to take those balances back on its balance sheet or not, and in general access a very significant, large group of deposits that, broadly speaking, are sticky. There's volatility there, but they're not the kinds of deposits that are just going to get up and leave in 6 months because their relationship with their advisor tends to be very, very long-lasting. So if you look at that part of this program and how, or using the program with that kind of customer, I should say, there are two main questions that any investment advisor, and for that matter, anybody that's working on behalf of any type of customer, has to answer about where it's placing those customers' funds. And those two issues are around, I think the primary ones are around credit and liquidity. Obviously, yield and return is a third, but I think you have to start with credit and liquidity. The story there is very simple, that everything is FDIC insured. Everybody that works at a bank, everybody that has deposits at a bank, basically understands what FDIC insurance is. We offer $30 million in FDIC insurance based upon each FDIC category. So an individual would get $30 million, but a joint account would get $60 million. But again, that $30 million would apply to every type or each of the FDIC insurance categories. Never had a loss to a depositor of an FDIC insured deposit. That everybody knows that. And more importantly, R&T has never had a bank failure in any of its programs. So there's never been an issue about money being locked up for any period of time. And adequately capitalized banks, while they can take deposits, can't grow them. They can't increase the amount of deposits they had from the time that they became adequately not well capitalized. Liquidity, as I indicated, every deposit in the program is an MMDA or DDA, so it's fully liquid at all times. The program offers same-day liquidity for many customers with cutoff times as late as 3:15. Everything is Eastern Standard Time. So there's no risk to principal of any monies that come in. There's no floating NAVs the way there could be with any kind of a mutual fund. This is no different than if that specific individual, specific company, specific municipality simply put $5 million into their checking account. The only difference is now that $5 million is insured, not just $250,000. So we provide the same liquidity that somebody would get if they had their money sitting in a checking account at your bank. It's just going to be held at checking accounts at other banks. Now, one of the key things from a brick and mortar banking perspective, so for core banking clients, is the integration structure that we have, and we're integrated with effectively everybody that provides core bank processing systems to banks. FIS, Fiserv, and Jack Henry obviously are the three big ones, but we have others. There are some other smaller players. We are integrated with all of them and can turn this into somewhat of a turnkey operation for banks. We do the same thing on the trust and accounting side. Most wealth managements, or all wealth managements in essence, are going to be sitting on a different kind of core system, a core trust system as opposed to a core banking system. And we're integrated with the same thing there as well, with all of the big players and others here that aren't even mentioned. It's important because it becomes critical over time that operationally these programs are easy to use, and integration is a key component, and we are in fact integrated with pretty much everybody. How does that integration work? Well, one of the key things, especially on the banking, on the core banking side, is that banks will go in and set a peg balance for an individual customer based upon their normal daily activity, and say, as an example, everything over $100,000 sweeps out, or everything over $250,000 sweeps out into DDM. And if their balance goes below $100,000 in their checking account, we sweep money back in from DDM. Through the integration that we have, those core processing systems actually create transactions. So a client that has a peg balance of $250 deposits money to take it up to $400,000. Core banking system will actually create a transaction, take $150 out, send it to us. Likewise, if a client has $250,000 in their account and takes $200,000 out, and thereby going below the lower bound peg balance of $100,000, the core banking system will create a transaction to take money out of DDM, put it back into their checking account, so their balance returns back to $250,000. Balances are swept on a daily basis in and out of these accounts automatically. And when a bank does this on a reciprocal basis, money never even changes hands. So on a reciprocal basis, if client A, a transaction is created, sweep $200,000 out of their checking account into DDM because they deposited funds, the bank would owe DDM $200,000, but since they're reciprocal, DDM would owe the bank $200,000. You owe me $200, I owe you $200. The transaction is netted, and money never moves hands. You simply make a journal entry on your side to reflect where the balances are, but you don't have to worry about wires late in the day. On the trust and accounting side, these would work the same way as they would work for existing sweep programs. There would be a sweep structure set up, to run at 1 o'clock, 2 o'clock, 3 o'clock, and they would simply send us the result of that sweep program, so that we would maintain all of the balances in sweep accounts on our network, send them out to FDIC insured banks in increments of $250. And then the parent bank of that wealth management group would then decide whether or not it wants to take any, all, some of the funds back onto its balance sheet in the form of a reciprocal deposit. We provide statements to individual clients. Again, we don't want to be known as the person or entity providing these services to your customers. So we'll put your logo on a statement that we create, give you that statement in a PDF format, whatever makes sense for you. We have tremendous flexibility there. And as you can see, the statement will end up looking very much like a traditional bank statement, but we'll show this customer where their funds are in our program on a daily basis, and it maintains the relationship between the bank and its customers, as opposed to creating a relationship between R&T and that end customer. So you have the ability to give your client statements. Those statements can be uploaded onto your system to the extent that you want to do that. They can be mailed out to your clients. Again, tremendous flexibility. We also have a real-time deposit view client portal. Basically, clients can go in and see where their balances are being held, see transaction history. They can opt out of banks, and banks have the same broad ability. They can see where every client is. They control who has access to that system so that they can activate or deactivate accounts. They can unlock locked accounts, and in one ID can view all of their customer accounts in one place. It can be accessed through a smart device, phone, iPhone, iPad, Google, Android, etc. Again, a very attractive client feature for the program. So as an overview, I mean, we talked about each of these points. We offer $30 million in insurance. You know, with the passage of CRAPO, reciprocal deposits are now much more attractive in a bank core funding strategy. To give you a sense of the impact that bill had, before that bill, reciprocal deposits were growing between 15 and 18% a year off of a much smaller base. And since the passage of that bill, they've been running between 40 and 45% a year. That kind of growth on a base that is now multiple times the size of what it was 6, 7, 8 years ago is very hard to maintain, but the demand for these deposits and the use of these reciprocal deposits has been tremendous. Even in the pandemic, even in 2020, reciprocal deposits grew by in excess of 35%, in probably the worst market, you know, for banks seeking high-level deposits because they were so overfunded. The program is integrated, can also be handled on a position-traded basis for entities that, for whatever reason, don't want to build, have their provider build the integration. And importantly, can be used for the trust and wealth management as a way to bring customers and deposits back onto a bank's balance sheet that had really lost access over time. So with that, I first want to thank everybody for their time, but move on to Q&A. So to the extent that anybody has any questions, I'd be happy to field them now.
Okay, Tom, thanks for that. We are a little bit into overtime on today's 45-minute program, but I do want to ask one question that has come in during the presentation. Tom, what paperwork does our client need to sign to enter the DDM program? Can you answer that one, please?
They would just sign one simple agreement with us that outlines basically a couple of big things. One is that they're doing AML and KYC, and that they've got the right to act on behalf of their clients. Not that they're a trustee or anything like that, but they've got the act to write on their work on their behalf of their clients. The key thing is there that their end client doesn't need to sign a specific contract with us. They can sign an agreement in whatever form the bank wants with their end client. Thereby, they can fit it into a suite of agreements that they provide to their clients. But it's just one simple agreement that they have to provide, that they have to sign with us that would cover both sending, receiving, and reciprocal deposits.
Okay. So, Tom, thank you for sharing your insights and your expertise with us today. As a follow-up to today's session, participants will receive an email from BAI within 24 hours that will include links to the webinar recording and a copy of the presentation. We encourage you to share the link with your team or with other peers who might benefit from the insights that Tom shared with us all today. You can learn more about BAI and find other relevant content and actionable insights, such as the BAI Banking Strategies podcast. That's on our website, www.bai.org. This wraps up our session. Thanks again for joining us, and enjoy the rest of your day.